Welcome to our Mindful Moments webinar. Just some housekeeping. We applied for Continuous Professional Development or CPD points. It is important to please watch the full session and add your ID number to the CPD section so we can verify your attendance. You may also view this event on this platform at any time until the end of June and receive your CPD points. The CPD certificate will be mailed to you during July. Please feel free to ask questions in the Q&A section and our speakers will answer them live. You can find more information about our speakers under the speaker tab on the top menu bar or if you scroll down. I do hope that you enjoy this webinar and find it valuable. First up is Theo Tereblanche, our Executive Head of Investment Management, who will do an introduction and set the scene for this webinar. The stage is yours, Theo.
Thank you, Mike. Good day, everyone. Thank you for joining us for the latest installment of our Mindful Moments webinar. It's hard to believe that it's been 3 years since the onset of the global COVID-19 pandemic. Who will ever forget the 1st of May 2020, the first day we were allowed to exercise outdoors again? I don't think I've ever seen or will ever again see so many people enthusiastically taking up exercising all at exactly the same time. So much has changed since then. We found new ways of communicating with each other, of organizing ourselves and the way we run our businesses, and we've also found a new appreciation for the importance of the health and general well-being of ourselves, our staff and our clients. The global economy has also changed significantly over the last 3 years. Gone are the days of cheap and easy access to capital to combat the impact of strict lockdowns. This has been replaced by tighter monetary policy around the globe as inflation rose to 40-year highs. Although inflation has peaked, it's certainly proven to be stickier than anticipated or hoped. Last year was especially tough for our multi-asset portfolios, with almost all asset classes delivering low or negative returns, and investors are rightfully asking, what can we expect going forward? Another significant change has been the further relaxation of offshore limits under Regulation 28. Although we've seen this gradually increase in offshore limits over the last decade, the most recent changes have certainly made all investment businesses take notice and reevaluate the way we manage our funds. No longer can managers just outsource the global component to a single manager or invest in a single asset class, and the new dispensation requires some fresh thinking from the industry. It's then no surprise that the theme of our session today is Destination Global, Evolving Opportunities. Before introducing you to the agenda we have lined up for you today, please allow me to share a few focus areas in our business with you. We pride ourselves in our research capability, always searching for ways to improve our portfolios and to innovate. Our Research Hive initiative has been in existence for the last 18 months, bringing together all the research skills across our business to leverage these skills and to set priorities. Over the last 6 months, the team has focused on topics like our new global approach, the impact of technology on the investment process, and behavioral finance, and the effect this has on portfolios. Towards the end of last year, we concluded the first round of our Pambili internship program. The 2 candidates had the opportunity to get exposure to all the different capabilities and the teams in our business, and we're pleased that both have found permanent employment in our business. For the new year, we've expanded our program with 3 new interns joining, coupled with a new bursary program launched in February of this year. We believe in the benefit of a diverse team of investment professionals, and we continue to grow the strength of our bench in the investment team. We've recently appointed a number of analysts in our team, and we're also pleased about the fact that more than 80% of our appointments in the business over the last 2 years have been ACI candidates. Over the last few years, the importance of responsible investing and matters related to environmental, social, and governance factors have increased significantly. Sustainability and responsible investing is close to our heart, and I hope you've all had the chance to read our 2022 Stewardship Report on our website for more details around our initiatives and progress. I'm sure you'll enjoy today with us, and you'll find the topics interesting and the opinions insightful. And as always, please feel free to reach out to us afterwards if you'd like to engage further on any of these topics discussed today, or if you have any questions. Thank you.
Thank you, Theo, for setting the scene for us. And next up is our economist, Sanisha Pakrisamy, who will discuss the known unknowns plaguing the outlook for the global economy. Take it away, Sanisha.
Thank you and welcome. The future is fundamentally uncertain, but today there are an unusually large number of unknowns facing the global economy. Former United States Secretary of Defense Donald Rumsfeld famously remarked that there are known unknowns, things that we know we don't know. In this age of permacrisis, there is a long list of known unknowns. We know that the world economy is likely to suffer some economic damage following a sharp tightening in monetary conditions, but we cannot yet quantify the final damage in economic growth terms. We know that jobs are likely to be lost, but we do not know where levels of unemployment will settle. We know that geopolitical fragmentation remains a key threat to global economic growth, but we are uncertain as to the outcome for international relations. The World Economic Forum, or WEF, notes that the health and economic after-effects of the COVID-19 pandemic quickly spiraled into a compounding crisis. The WEF also highlighted how food and energy became weaponized by Russia's invasion of Ukraine, which sent inflation soaring to decades-high levels. The cost of living crisis that then ensued reached all corners of the globe and ultimately fueled social upheaval in a number of states in both the developed and the emerging world, as inequality within and between countries continued to rise. As we enter an era of less accommodative monetary and fiscal policies, governments, individuals, and businesses will likely face more challenging conditions in acquiring and maintaining debt. Although we are through the worst of the pandemic and likely also the Russian invasion of Ukraine, economies will not rebound quickly from these calamities. The International Monetary Fund, or the IMF, warns that the output gap, which is just the difference between actual and potential growth, is expected to widen to a cumulative output loss of 2.7% of GDP by 2026. This indicates that world growth is definitively worse off, given the effects of the pandemic and the war in Ukraine. Similarly, the Organization for Economic Cooperation and Development shows that potential output growth has slowed significantly since that 15-year period leading up to 2010 for both key advanced and emerging economies. Activity in the world economy snapped back reasonably quickly following the global recession in 2020. This latest recession was, of course, triggered by stringent lockdown regulations across the globe to help slow the spread of COVID-19. Governments and officials embarked on massive fiscal and economic policy interventions to help restore economic, social, and health outcomes. But only now is the world coming to grips with the unintended consequences of these actions and the externalities that have extended to poorer nations. The first of these known unknowns that we are dealing with is how the global economy will respond to the abrupt shift from ultra-accommodative policy to a more aggressive tightening stance. The world's largest central banks, being the United States Federal Reserve and the European Central Bank, flooded markets with liquidity via their bond purchasing programs. Firstly, after the global financial crisis, but again in the aftermath of the pandemic. Inflation has nevertheless caught up, and in the recent year, central banks have had to battle the highest inflation rates in decades. This forced interest rates significantly higher over a very short space of time. Market liquidity is being drained even further by central banks, either selling securities outright or choosing not to roll over bond holdings that have already matured. Moreover, core or underlying rates of inflation remain sticky, despite the drop we've seen in food and fuel inflation. Initial rounds of high food and fuel prices have spilled over into other areas of the basket, notably wages and services. with the IMF noting that inflation is unlikely to return to target for many economies before 2025, central bank rhetoric has remained hawkish. Given the sharpest pace of monetary policy tightening in almost 4 decades, home prices have also crashed in response to higher mortgage rates across a large number of key economies, including New Zealand, Sweden, Australia, and even Canada. With central banks telling us that they are unlikely to reduce interest rates at least until they see clear signs of inflation on an obvious downward trend towards their respective targets, a tight monetary policy stance could exacerbate growth woes in the global economy and raise the risks of a harder landing. This is particularly true given the effects of tighter monetary policy on the financial sector. The IMF notes that the fall in the gilt market in the United Kingdom last year and banking turbulence triggered by a few regional banks in the United States more recently highlight the vulnerabilities in certain segments of the financial services sector, most notably in areas where credit system has been intermediated by unregulated non-bank entities. Now, even though commercial banks are far better capitalized today than where they were in the run-up to the 2008 global financial crisis, problems in this part of the financial sector can have negative spillover effects elsewhere, particularly for entities with excess leverage, credit risk, or even interest rate exposure. The IMF warns that this could extend at a country level, with tighter global financial conditions potentially creating a risk-off event, triggering capital outflows from perceived riskier jurisdictions. This would ultimately have a negative effect on risk premia, confidence levels, and even spending and investment in these countries. The combination of higher interest rates and significantly slower growth comes at a time when the world is mounting the incline of the debt roller coaster. The Bank for International Settlements, or the BIS, warns that mounting debt is yet another challenge facing central bankers as they try to rein in hot inflation. Very high debt levels, both in the private and public sector, heralds more sensitivity in the global economy to a further rise in interest rates. The IMF notes that world debt has reached a whopping 250% of GDP. This is nearly 20% higher than where we were in 2008. But it is more than just on-balance sheet debt that poses a risk to the outlook for global economic growth. The BIS has flagged the risk of hidden off-balance sheet debt. The BIS claims that pension funds and other non-bank financial firms have more than $80 trillion worth in debt in foreign exchange swaps. The BIS notes that this could be a blind spot for policymakers, and they warn of the risk of potential funding squeezes. The share of countries facing a high risk of debt distress is elevated by historical standards, and this gives rise to potential fiscal shocks. Particularly so if structural reform efforts on the part of fiscal and macro authorities are seen to be lagging. Despite a lower level of external debt relative to gross national income than what we experienced in, say, the 80s or 90s, a higher share of debt today is issued at variable interest rates and in US dollars, both of which increases external risks. The IMF calculates that more than half of low-income developing economies are already in debt distress or at a high risk of reaching this level of vulnerability. Similarly, a quarter of emerging market economies are being viewed at high risk of debt distress. Now, over in developed markets, a looming budget fight could result in a fiscal showdown in the United States. Now, the debt limit sets a legal maximum on the nation's outstanding debt. And once that limit has been reached, government can only spend what it receives in revenue. As such, running a government deficit means that government may not be able to pay all of its bills on time, and this could potentially lead to a government default. Now, while the drama of the debt limit has intensified every time the new limit has been breached, it has often resulted in a last-minute resolution. Nonetheless, investors cannot overlook this as a potential risk to destabilizing financial markets, particularly as we approach the middle of the year. Although China's economy is set to rebound this year after activity recovers from authorities lifting strict lockdown rules, China's debt mountain, largely driven by credit fed to state-owned entities, poses a risk to longer-term growth. Moreover, the contraction in China's real estate market is a major headwind to growth dynamics, even in the short term. A shrinking population and slowing productivity growth also argue for lower trend growth rates out of China in the longer term. Now, by raising household spending and services as contributors to overall growth, an inward focus of Chinese policies suggests positive growth spillover effects for the globe will be lesser than before. There are a number of red-hot geopolitical flashpoints in the globe that threaten to unravel global economic prospects and could even sour international relations, leading to an erosion of the existing systems of global cooperation and governance. These include a security crisis over Taiwan, led by China, escalating tensions between China and the United States, the rise in economic nationalism, a prolonged conflict in Ukraine, American relations in the Gulf, and renewed confrontations between Iran and the West. With regards to the first geopolitical flashpoint, China's potential invasion of Taiwan has already undermined trade relations and has caused a dip in business confidence amongst China's trading partners. Speculation is rife around a potential acceleration in the shift in global supply chain orientation, which could have a significant bearing on the structure of the world economy and even trade relationships. Escalating trade tensions between the world's largest two economies, being the United States and China, could also significantly disrupt international trade and relations. The trade war is now extended to technology and even possibly currency wars, fueling stagnation in globalization trends. Now, in the past, we've seen how a coordinated response of major economic superpowers can prevent an even larger catastrophe during times of crises. However, the Peterson Institute for International Economics shows that a rise in nationalist economic policies across the globe could result in authorities resolving for short-term domestic pressures, making it much harder for governments to focus on the longer-term priorities. This could result in limited political capital being allocated to broader global concerns. And in turn, this could exacerbate trends in political polarization and accelerate an erosion in social cohesion and geopolitical frictions, leading to further inequality within and between countries. Increasingly, policy platforms of the largest political parties within the G20 countries are stressing national sovereignty and rejecting multilateralism. History has shown that when countries adopt individual responses rather than using a coordinated approach, these actions can aggravate a global slowdown. This is particularly true when protectionist policies are adopted and currency devaluation practices are then taken on board. The geopolitical landscape has also become very closely intertwined with the rise in coordinated cyber attacks. Hybrid warfare appears to be the new reality, as seen with Russia's invasion of Ukraine and cyber attacks against critical national infrastructure. We are possibly entering an era in which state actors utilize cyber attacks to disarm global economies. This trend poses a risk to numerous industries, spanning from the energy industry to financial services. The WEF warns that cybersecurity risks create yet another wedge for divergence rather than cooperation among countries, especially where already heightened tensions exist. Finally, geoeconomic fragmentation poses a risk to forming a collective response to global challenges, such as tackling climate change. The long-run effects of not mitigating climate change effectively will result in significant economic damage to the global stock of labor and capital. Moreover, inflation will likely rise as production in global crop yields decline. In addition, higher insurance premiums will raise business costs that will ultimately be passed on to consumers. Climate change is worsening livelihoods in regions that are more vulnerable to changing weather patterns. It is becoming an increasing driver of displacement and migration, competition over limited land and water resources, and even food insecurity. The United Nations reported that 9.8% of the world's population were affected by hunger in 2021. This compares to a lesser 8% in 2019. Now, these 10 known unknowns, which span a multitude of dimensions, including political, societal, regulatory, and economic facets, suggests that market volatility will remain high in markets. Indeed, these areas of vulnerability should raise concern over the prospect of a more meaningful slowdown in global economic activity, but it could also give us clues of how market returns are likely to shape up. While some of these known unknowns could turn out to be less damaging than initially anticipated, we need to remain aware of possibly even some of these risks derailing the world economy's shaky recovery. Moreover, what about the unknown unknowns, as Rumsfeld referred to? The risks we don't know. These perils lurking in the background further complicate economic policy making. As such, it remains imperative for global authorities to adopt a globally integrated, risk-based approach to policy making in order to detect and address economic vulnerabilities early on. Strengthening international cooperation, rebuilding multilateral governance, and pushing past short-term national responses are all necessary tactics for the global economy to navigate this complex risk backdrop. Only then can we balance macro resilience with inclusive growth outcomes. Thank you for your time.
Thank you, Sanisha. Next, Mohamed Zibda, our Senior Multi-Asset Class Portfolio Manager, who will review our key economic events, market and portfolio returns from April 2020 to March 2023.
Thank you, Mike, and hello, everyone. The last 3 years was one of the more interesting periods for many of us. It almost felt as if there was a new event on a weekly and monthly basis that we had to digest, filter, and make the most appropriate decision at the time. If we just spend a bit of time looking back at some of the more pertinent events since April 2020, that was the time that the world realized we were in the midst of a global pandemic. One will realize just how much has happened from a medical, political, economic, and financial market perspective. From a medical perspective, obviously we had to deal with new variants, new waves, adjusted lockdown measures, reopening, and the sudden reclosing of international borders, businesses, the development of vaccines, apparent vaccine hoarding, vaccine hesitancy, 2, 3, 4, and even a 5th booster shot. We could probably dedicate an entire presentation to the political stories that dominated the headlines over the last 3 years, but some of the more noteworthy included the US election and allegations of a stolen result, which led to the bizarre storming of the US Congress, or as the US called it, an insurrection. Disjointed and almost dysfunctional UK government resulted in having 3 prime ministers in a matter of a month. This political turmoil was evidenced with the bet also being placed that the lattice would outlast the prime minister. Europe was relatively calmer to the US and the UK, but there were the occasional public flare-ups against some of the more stringent lockdown measures. More importantly, the UK and Europe experienced a cost of living crisis in 2022, with higher energy and food costs having a material impact on citizens. The Chinese regulators' crackdown on tech companies and limiting the time spent on gaming during the period was also noteworthy from a market perspective. And finally, tensions between the US and China was, and probably still is, key not just for global politics, but for global trade and investments as well. It is fair to say that the relationship between these two powerful nations is not great at the moment and could possibly escalate in the future. And perhaps the most noteworthy political global event over the last 3 years is the Russian war on Ukraine, which at the time of the recording was in its 15th month. While the loss of human lives is obviously the most important factor, there has been serious economic and political ramifications as well. Locally, we had the arrest and the release of the former president, and we even had our current president answering to the Pala Pala inquiry. He almost resigned just before the ANC conference as well. In 2021, we witnessed the looting and destruction of shopping malls and large stores across the country. And unfortunately, we had and we currently have the ongoing allegations of corruption and misappropriation of taxpayers' money. The intensity of load shedding in the last years has also reached new levels. And while companies have reported on the effect on the income statements, the true rand cost to the overall economy is so much higher. The intensity of load shedding in the last 3 years also reached new highs. While companies have reported on the effect on the income statements, the true rand cost to the overall economy is so much higher. So now if we move on to some of the economic effects, the economic effects for the initial stages of COVID was absolutely brutal. We saw one of the fastest slowdowns in economic activity as a result of the global shutdowns and significant job losses in almost all sectors, with the tourism, entertainment and retail sectors affected the most. Fortunately, policymakers were quick to react by implementing loose monetary conditions, that means cutting interest rates, and fiscal measures either through lowering taxes and or government spending. They were for the most part able to avert a complete collapse of economic growth. The introduction of relief measures to businesses and households during this period also contributed to the recovery. These measures resulted in one of the sharpest recoveries in global economic growth. After the collapse in asset class prices in the first quarter of 2020, we also saw a dramatic recovery in global equity indices. The initial stages of the recovery were quite concentrated, with growth shares outperforming the rest of the market as they benefited from these record low interest rates. Tech and healthcare shares in particular recorded strong returns from April 2020 to around December 2021. Inflationary pressures started building towards the middle of 2021 as the very accommodative monetary conditions took effect. Global supply chain disruptions and the shortages of goods as a result of lockdown measures also added to inflationary pressures. Central bankers were initially hesitant to increase interest rates as the economic recovery was still not broad-based, and they definitely wanted to avoid a possible double-dip recession. The war in Ukraine exacerbated these inflationary pressures as energy and food prices increased substantially. CPI in the developed world reached new all-time highs, which in turn led to interest rate hikes across the world. The pace and extent of these interest rate hikes created market volatility, with high-duration growth shares selling off and value shares like banks and energy shares outperforming for the most part of 2022. In fact, 2022 as a whole was quite a challenging year for investors as US equities and bonds both posted negative returns. The burning questions now are whether these aggressive interest rate hikes could result in a deep and protracted global recession, or if and when inflation will return to central bank targets and if central banks will keep fighting inflation. Whilst we, like many other managers, do not know how these central bankers will respond, we are comfortable that our portfolios are suitably diversified. A snapshot of the 3-year returns for the period April 2020 to March 2023 will highlight the remarkable recovery of asset class prices, but this will mask the volatility we witnessed during the period. The graphs on the following slides are probably a better reflection of what investors experienced. So if we first focus on the asset class returns, one will notice that with the exception of global bonds, all asset classes delivered positive returns. Local equity was the top performing asset class. Local and global property took longer to recover as the new variants affected the reopening of property and retail sectors. If we look at some of the global equity indices, as mentioned earlier, the tech-heavy Nasdaq recorded strong returns during the first half of the period, led by gains in mega caps such as Apple, Amazon, Google, and a number of tech companies that benefited from the work-from-home way of life. Pharmaceutical and healthcare shares also contributed to the outperformance of the US equity markets. European and equity markets benefited from the higher interest rates and high energy prices, as these markets have larger weightings to these sectors. Conversely, the Nasdaq retraced on the back of higher interest rates during 2021 and 2022. If we look at emerging market performances, emerging markets underperformed largely as a result of the weak performance of the Chinese and Russian markets. On a positive note, the SA market outperformed despite the rand's marginal depreciation. Turning our attention to the local equity market, resources and industrials returned healthy returns for the period. Within the resource sector, there were periods when certain industries outperformed the broader sector. Platinum and gold shares had a great 2022, diversified miners did well during 2021, and oil and energy did particularly well in 2022. Rand shares drove the returns from the industrial sector. Naspers and Prosus were strong contributors in the last 6 months or so. Local retailers like Foschini, Shoprite, Clicks and Woolies also recovered from the drastic collapse in share prices in the first quarter in 2020, as these companies proved to be much more resilient than what the market initially expected. Banks led the recovery within financials. The strong balance sheets and very attractive dividends helped to drive the returns of the banking sector. So from a performance perspective, I think we are definitely pleased to report that our portfolios were well positioned to benefit from the recovery after April 2020. All the actively managed institutional multi-asset class portfolios achieved double-digit returns for the 3 years ending March 2023. The more conservative portfolios with lower growth exposures had returns in the region of around 14% per annum, while portfolios with high allocations to local and global equity recorded returns of between 17 to just under 18.5% per annum. These returns were ahead of their respective benchmarks and in line or above the peer averages for the 3 years ending March 2023. These returns are a testament to the combined effort of our investment team, always looking at measures to improve the process and enhance the returns we deliver to our clients. There were a number of sources which contributed to these returns. Firstly, our asset allocation contributed, in particular the weighting to local and global equity, as they were strong drivers of absolute returns. Our portfolios captured the very rapid recovery in equity markets in 2020 to mid-2021, and we benefited again from the bounce back since the third quarter of 2022. Although we reduced our listed property exposure, we benefited from the recovery from this asset class in 2020 and 2021. Our active local equity portfolio, namely the Momentum Classic Equity Portfolio, which is used in the Classic and Enhanced series, returned an annualized return of 25% per year for the last 3 years, outperforming the benchmark return of 23%. We think this is a great outcome given the volatility during the period. Our style diversification and maintaining high conviction investment manager views were handsomely rewarded. Our marginal tweaking of investment strategies and managers also contributed to this outperformance. Being overweight the likes of Naspers, Prosus and the banks during the course of 2022 contributed to returns, and the defensive plays like British American Tobacco and Richemont were equally contributors to returns. Our active global equity solution also contributed to our active returns during the last 12 to 18 months. Being underweight tech and moderately overweight energy and banks explained most of this alpha. Our allocation to hedge funds and private equity also added to the absolute returns and was a further source of alpha. The macro thematic strategies in equity and fixed income hedge funds were the strongest contributors to returns for the last 3 years. Hedge fund strategies benefited from the volatility during the period as investment managers were able to take advantage of relative value opportunities across asset prices. Within the equity hedge fund strategies, we had a meaningful long position in gold shares as a broad hedge, as well as long resource position, which contributed to the performances. Within fixed income strategies, the investment managers were correct to call a more structural inflation trajectory. After experiencing a tough 2020 on the back of the lockdown measures, private equity gradually recovered and has been an additional source of returns. Returns over the last 2 years were in the region of 20% per annum, which was comfortably ahead of the Capswix return of 10%. Direct property also recovered as rental collections recovered, as more tenants returned to offices and the rental concessions offered to retailers reduced over the period. We will now focus on our current portfolio positioning. We'll start off with our offshore allocation. So during the last year, we increased our offshore allocation gradually and opportunistically, but did not move to our revised strategic asset allocations as yet. We are still mindful of the relative valuations, the level of the rand, and global macro uncertainty. This is a view held by many of the local investment managers, and the dispersion between investment manager returns going forward could be a function purely of the global allocation. The increase in global exposure in our portfolios has been predominantly through increasing the defensive asset classes, that would be bonds and cash, as these asset classes have provided better entry points and will also provide greater downside protection in the event of a risk-off period. We still retain a healthy allocation to both local and global equity across our portfolio range. We think local equity in particular has the potential to deliver decent inflation outperforming returns over the next 3 to 5 years. SA equity is still trading at a discount to its long-term averages and is cheaper than most developed markets. We are acutely aware of the negative sentiment towards SA, but we think investors are being compensated for these risks. It is also worth noting that a large number of these companies derive their revenues offshore and have very little exposure to the SA economy. Our preference over global equity to global property is based on better risk-adjusted returns. Within global equity, we have a 25% allocation to IT, 20% allocation to consumer discretionary, and 15% exposure to financials. We are comfortable with these regional style and sector allocations given the global macro backdrop and valuations. Within SA fixed income, we have increased our cash exposure as interest rates have increased to very attractive levels, but we still retain a decent allocation to SA nominal bonds as they offer great inflation outperforming returns. We have also been rewarded by taking a longer term view on some of the strategies and positions which have recovered and outperformed recently. Our high conviction decisions to stay overweight local and global equity for the most part of the last 3 years, together with our strategy diversification and investment manager selection, contributed meaningfully to absolute and active returns. We will continue to increase our offshore weighting in a prudent and responsible manner. And as always, our portfolios are well diversified across asset classes and strategies, and are confident that our portfolios will be able to navigate through market volatility and deliver on their respective longer-term objectives. Once again, we thank you for your attendance.
Thanks, Mo. And now, Eugene Botha, our Deputy Chief Investment Officer, will discuss the breadth of the global investment opportunity set and our partnership with Robeco. He will be followed by Andrew Hardy, our Director of Investments at Momentum Global Investment Management. Andrew will explain how they access global opportunities and how they complement the Robeco partnership.
Thanks, Mike. Good day, everybody. Today, Andrew and myself will spend a bit of time on not only global investment opportunities, but also shed some color and light on what we believe is the most optimal and effective approach for multi-asset class portfolios to gain exposure to the myriad of global investment opportunities at our disposal. Integration of South African and broader global assets and strategies is important, and being able to do that whilst at the same time extracting the benefits of a partnership with a well-established and philosophically aligned global investment manager is key to the successful investment delivery for our clients. With the relaxed exchange controls and resultant allowable offshore exposure of up to 45% in portfolios, global investing has become an even larger topic of discussion compared to the recent history. However, with the continuing implementation of tightening policy rates, a slowdown in global economic activity seems almost inevitable. As a result of the erosion of real spending power, it looks set to inflict more damage in 2023, which makes the timing of shifting your assets offshore a tricky one. The magnitude of the growth slowdown remains uncertain. A mild slowdown or soft landing is certainly still possible, but more indicators are pointing to the increased probability of a global recession. At the same time, a slow grind lower in elevated inflation and geopolitically a more fragmented world, growth in SA is set to moderate quite substantially for the year ahead. Recent negative political developments raising uncertainty over the leadership of South Africa pose significant downside risk to this moderated growth view. The result is that volatility in asset classes will continue for the foreseeable future, and increased volatility even more prevalent for challenged emerging market economies like South Africa, with potential global normalization perhaps coming through towards the latter part of 2023. Against this rather grim outlook from a pure South African perspective, some would argue now, more than ever before, it is essential to have some, if not most of your assets invested in global markets, if you take a longer-term view. Effective and holistic diversification is essential for South African investors, and offshore markets can offer just that. With South Africa being a mere 1% of the total global economy, offshore markets offer a myriad of different possible investments to choose from, and therefore represents the perfect way to diversify your portfolio of assets and grow your wealth. Whilst those global opportunities always existed, the impact it had on our diversified portfolio with a measly maximum of 30% exposure to these opportunities, it has always been an equity-centric approach for most multi-asset class South African asset managers. With almost half of your portfolio now being allowed to be invested outside of South Africa, there are a couple of obvious benefits for expanding the offshore investment universe. Diversification and protection from a weakening currency are the two primary and probably most important benefits. That said, not only does the increased allowable offshore exposure give you the opportunity to gain exposure to various different global assets, geographies, industries, economies, companies and exchange rates, but gives you the opportunity to invest into longer-term themes and growth opportunities in a meaningful way that might not be available in the South African market. Even though the investment opportunity set broadens, the global investment market can be a daunting place. The question around what and how to invest given the myriad of opportunities available therefore remains to be answered. We believe in the strength in numbers when it comes to global investing. And in this particular case, the more breadth we have in research, harnessing skill sets from various different experts and capabilities will allow us to lead the pack in goals-orientated performance delivery, risk management, innovation, and also staying abreast with global best practice. A collaborative effort to global investing does not mean or translate into committee-driven investment decision-making, but allows, as mentioned, the ability to focus on research and innovation within the respective areas of strength to support the investment decision-making and portfolio management on an ongoing basis. It is therefore clear to us that the 4 different pillars of strength involved in the collaborative effort each have a very important role to play in this ever-evolving world of investments. Firstly, the Momentum Outcome-Based Solutions team at Momentum Investments drives the philosophical approach of portfolio construction, managing the overall client investment proposition, and identifying asset classes and strategies, both locally and globally, that fit clients' investment objectives. Secondly, Momentum Global Investment Management in the UK is an extension to the investment and portfolio management team in South Africa. Geographically, with their location in the UK, gives them the edge in scouting the globe for innovative solutions, trends and ideas in partnerships with global investment managers. Thirdly, with the presence of the Momentum Investments Research Hive, with a dedicated research focus and academic partnership collaboration, allows us to invest into academically grounded theories. And lastly, the presence of a global investment partner gives us access to world-class research, execution strategies, and portfolio construction methodologies aligned to the overall philosophy and best practice principles. So why Robeco as a global partner when it comes to execution strategies? The answer to this lies deep within the philosophical grounding and approach to investing that Robeco follows as an asset manager. As a global asset manager, Robeco has a strong range of client-focused propositions in sustainable investing, quantitative, thematic, credit, and emerging market investing. Research lies at the heart of everything they do, with a pioneering but cautious approach that has been part of their heritage since their foundation in the Netherlands in 1929. Robeco has routinely integrated ESG across all their investment processes, are frontrunners in active ownership, and continuously push the boundaries of impact investing. Similar to Momentum, their vision is to create wealth and well-being for clients, with a mission to enable their clients to achieve their financial and sustainable goals by providing superior investment returns and solutions. Robeco is an active asset manager with a long-term investment view. Fact-based, disciplined and risk-controlled in everything they do, and with a strong research culture, has the ability to turn research into innovation. All important credentials and characteristics that rhyme perfectly with the Momentum approach. Being fully aware that the approach to global investing can be implemented and managed in multiple different ways, we believe that the partnership approach, as part of the broader collaborative approach to investment research, makes sense for a couple of reasons. With a partnership, it truly gives you the opportunity to research, identify, and create the optimal global investment strategy aligned to your client goal from multiple perspectives. Often, the optimal or most robust investment opportunities are found through innovation and research collaboration, which sometimes is overlooked by internally focused investment managers. Research collaboration widens the breadth and depth of research, again adding to the ability to innovate more often on anything investment related, including the likes of portfolio construction and design, innovative products, risk management, and ongoing investment management decisions and implementation. Global best practice remains top of mind with a view through the lens of a global asset manager. It remains priority and ensures that global best practice from all different perspectives in the investment world is applied consistently to investment portfolios of South African investors. And then, very important, is the aspect of costs. Global investment strategies have traditionally been the most costly component of a South African multi-asset class portfolio. The focus on global fees and costs are becoming more prevalent, and pressure is mounting for reduced fees. A partnership agreement, therefore, allows for the benefit of economies of scale to be passed on to the clients more often than not. In summary, what we aim to achieve through a global investment partnership is really risk-managed, long-term, sustainable growth opportunities at the right costs through the lens of a client objective. Local and global asset classes can and should no longer be seen as separate and independent. Therefore, a well thought through, integrated approach to investing, taking into account all elements of risk and potential return from all aspects of the portfolio, is not a nice to have, but a non-negotiable in client portfolios. A structured and properly thought through research framework and collaboration on strategic initiatives allows for ongoing innovation at a greater scale, whilst at the same time enriching the investment debate from a slightly different perspective, all working towards the same goal of enhancing financial wellness for our clients. Given the alignment of sustainability within Momentum Investments as well as Robeco, the partnership also therefore gives us the opportunity to drive sustainable investments that positively influence the environment and society in general from both a local as well as a global perspective, entrenched in everything we do. From a more strategic perspective, I hope this adds a bit more color to the benefits and reasoning behind the Momentum approach to global investing. Andrew will shed some more light on what all of this means from a practical perspective, how the array of global investment opportunities come together, and how a partnership agreement can sit alongside and complement a broader active manager selection approach as a robust investment proposition to our clients. Over to you, Andrew.
Thanks very much, Eugene. I'll now spend a few minutes outlining our approach to harnessing and integrating the global opportunity set through a combination of asset allocation, strategy selection, and portfolio construction. First of all, we believe in making the very most of the investment toolkit available to us. By using the full breadth of it, we can build allocations that deliver superior returns while maximizing diversification benefits, particularly when you're thinking in a holistic context to complement local market allocations. As this chart shows, that means going far beyond the typical naive equity and bond balance fund construct to include a range of other harder to access but very valuable allocations such as real assets and alternatives, as well as including a range of styles, geographies, managers and securities. Once you've defined the universe like this, it enables a much more nuanced approach to strategic and tactical asset allocation. This makes it easier to take advantage of mispricing and market volatility. The uncertainty Eugene outlined is often uncomfortable, but for long-term investors it should be embraced. As well as building carefully considered long-term strategic allocations to each asset class to ensure a genuinely diverse range of return drivers, we also consider medium-term risk and return expectations and overweight or underweight each based on those. Valuation is the primary consideration here, but we also include a range of other inputs, including a machine learning model to complement the human judgment side, which nonetheless remains the primary driver. These slides show how we approach segmenting the offshore opportunity and how we currently rate the risk-adjusted return opportunity across each on a medium-term view, with 4 representing a neutral view relative to a portfolio's strategic asset allocation, while higher and lower translates to varying levels of overweight and underweight. Within equities, we see the best opportunities in the Japanese and UK markets, both areas which have very low weightings in a typical global equity strategy, therefore highlighting the need for a more specific allocation strategy. Whilst the US, which of course dominates global indices at approximately 2/3 weightings, looks relatively less attractive on current valuations following a decade plus of outperformance. Within fixed income, there are many sub-asset classes with very different characteristics that can help achieve effective downside protection and diversification for a portfolio. Currently, we're positive on emerging market debt, but wary of credit, where valuations look relatively unappealing. While we've recently upgraded sovereign bonds to neutral for the first time in many years, we take a highly selective approach to the countries and curve positioning beneath that. And as mentioned before, we believe it's key to broaden out the selection beyond just equities and bonds too, to real assets and alternatives in particular, areas that have delivered much better resilience to portfolios through this recent period of elevated inflation and volatility. So, having spoken a little about the asset allocation or beta selection side of things, let's look at the active security selection opportunity overseas. I'll focus on international equities given it's the largest and most important asset class. I often hear the view that active management doesn't work so well outside of SA because markets are too efficient. However, I'd say there's a mountain of evidence that says otherwise, and here's part of the reason why it can work so well. The universe is absolutely massive, as you see here, in terms of numbers of companies and market cap, but also in terms of breadth, depth, and liquidity. Global markets offer 100 times the number of companies and 250 times the market cap of South Africa. Picking a few dozen stocks, as many local managers do, is not even close to exploiting the vast opportunity here. Sell-side coverage of the largest few percent is indeed quite high, although whether that translates into effective pricing is up for debate. But be that as it may, there are many thousands of large, world-class companies with far less or lower quality sell-side and buy-side coverage, which creates many a long-term investment opportunity. Carefully considered manager selection and portfolio construction is absolutely key though. And challenging that misperception about the alpha opportunity in global markets from another angle, here we see that active global equity managers have delivered on their potential. This chart shows nearly 30 years of returns for a peer group of global equity strategies measured relative to the global equity index. I've used 7-year rolling returns here, which I think is a more reasonable horizon to measure the success of actively managed strategies over, rather than shorter horizons, and indeed reflects our longer-term minded investment approach. On this basis, you see that the median active manager has outperformed the index over every rolling annual horizon, while the top quartile has consistently performed very well, with roughly 2% of outperformance per annum or more. Now, it's clear to see that the last decade has been a more challenging period for active managers, but they still delivered value over and above the index nonetheless. Plus, I'd argue the recent downwards trend is cyclical rather than structural, reflecting low rates and a huge shift towards passive index-based strategies over that period, which drove the outperformance of megacaps and the US market. But this has started to reverse in the past year or so, and I believe that could continue for a long time to come potentially. Note that these figures are gross to remove the distortion of fee variation and create consistency across time and managers. But related to that, I'd also highlight another benefit of a properly scaled and resourced offshore management business and manager selection team. That is our ability to access the world's best managers at low costs. The weighted average management fee in our global equity fund, for example, is approximately just 30 basis points. That research and strategy selection expertise is, of course, also key to identifying those managers ex ante that will go on to deliver superior above index returns, as well as to achieve the diversification of market and other risk factors in portfolios, to maximise the chances of delivering on return targets with a reduced level of drawdown and shortfall risk, and to ensure efficient use of fee budgets. This applies to varying degrees across all asset classes. It doesn't mean picking individual strategies that achieve all of those aims by themselves. Each one may in fact be individually more volatile, for example, but it's holistic portfolio construction or the sum of the parts thinking that has to be the focus here instead. As Sir John Templeton famously said, to achieve superior results, you need to do something different from the majority. So when selecting active managers, we focus on partnering with specialists who usually share most or all of the characteristics shown on this slide. They are often focused boutique businesses, but can also include larger firms, but with a clear focus and particular expertise, such as Robeco. As with the local market, our global team do extensive research to analyse all of these aspects and more before selecting a manager, and we keep the bar very high to ensure we always have truly best-in-class partners from around the world. This, I believe, ensures we have managers who deliver long-term results towards the top end of their peer groups, thus capturing much of that alpha opportunity I highlighted previously for global equities. Our global equity fund is over $1 billion in size and has been implementing this approach since inception 14 years ago, which has indeed led to top quartile results over that and other time periods. Then just touching on how we think about portfolio construction and continuing to run with the example of global equities, this slide outlines how we blend different strategies within that global equity fund, categorising them along what we see as two of the key lines of distinction between discretionary and systematic strategies and across distinct styles. Eugene outlined our partnership with Robeco, particularly for the management of quantitative or systematic equity strategies, which focus on capturing certain risk premia, including value, momentum and quality. Their proprietary definitions of these factors and world-class processes of creating consistent portfolio exposures to them sets them apart from more naive smart beta and other general quant strategies, while also allowing us to control exposure to each factor so as to achieve the right blend for our needs, including factoring in local holdings to achieve a truly holistic approach to portfolio construction. We do have some portfolios where Robeco manage all the underlying assets, but in this fund we combine their sleeves with discretionary strategies, as you see here. Discretionary and systematic strategies have very different characteristics, generally, listed in general terms on either side of the pie chart here, but together they create a powerful combination. And by picking specialists for each style, for each segment of that pie, we create further portfolio construction levers to optimise for a given asset blend or risk profile. By blending various focused specialist strategies like this, we can fully capture the high outperformance potential they exhibit, whilst significantly reducing overall risk because of the low to negative correlations that each of the style segments have with each other. And finally from me, as well as superior return outcomes, we believe the approach we've outlined leads to superior stewardship outcomes and ensures client assets are making a positive contribution to the world and society. That comes through from our own efforts on that front, for example, through the integration of ESG factors in our strategy selection and portfolio construction, and being long-term signatories to the UN PRI, as well as through similar endeavours and engagement activity by our partners. Robeco stand out on this front, as Eugene outlined, which is our long-held view that is supported by plenty of external validation too, but many of our other partners also make a huge contribution to this. Ultimately, I believe a hands-on, truly active approach done properly leads to much better long-term stewardship than passive and, by definition, more hands-off strategies. These opinions around the effectiveness of our stewardship approach are, I think, well validated in our regular responsible investment reports, which are available on our website. In conclusion, what I hope Eugene and I have made clear is the importance and value of a truly active, integrated and holistically managed investment solution, as well as the benefits of working with a handful of leading specialists across various disciplines. There's a world of opportunity out there, as well as risks, particularly today, but I firmly believe you need a world-class framework and resources like we have to establish the right long-term partnerships to unlock these. Thank you for joining us today.
Thanks for joining us, Andrew and Eugene. Up next is Nina Saad, our Head of Institutional Portfolio Solutions, who will summarize and close the webinar for us. Thank you for joining us today. Take it away, Nina.
Thank you all for attending today's Mindful Moments. I hope you found it engaging and informative. In concluding the day's session, I would like to take a few minutes to recap on what was discussed today. We are in a unique period of history where we are experiencing a number of crises at the same time, while the cost of living crisis has reached all corners of the globe. Sanisha spoke about some of the known unknowns, the things that we know we don't know, that are stalking the global economy. These risks span across a number of dimensions, including political, societal, regulatory, and economies. The first of these known unknowns that we are dealing with is how will the global economy respond to the abrupt shift from ultra-accommodative monetary policy to a more aggressive tightening stance. Central banks are telling us that they are unlikely to reduce interest rates until they see signs of inflation on a clear downward trend. This raises the risks of a hard landing rather than a soft landing. There are question marks over financial stability. There is an increasing risk of debt distress, and investors cannot overlook the potential debt ceiling showdown in the United States as a potential risk to destabilizing financial markets. What does slower Chinese growth mean for commodities? Inwardly focused Chinese policies suggest that the positive growth spillover effects for the globe will be less than what we have historically been accustomed to. Furthermore, geopolitical risks abound. The security crisis over Taiwan, escalating tensions between China and the United States, and a prolonged conflict in Ukraine, to name but a few. The geopolitical landscape has also become closely intertwined with a rise in coordinated cyber attacks. And then we have the risk of climate action failure, where climate change can increase the risk of food insecurity and conflict. These known unknowns certainly suggest that volatility will remain high in financial markets. Now, what about the unknown unknowns, which further complicate economic policy making? Mohammed then took us through how we at Momentum Investments have successfully navigated our portfolios over the last 3 years, post the onset of the COVID pandemic, where, for the most part, policymakers were able to avert a complete collapse of economic growth. These measures resulted in one of the sharpest recoveries in global economic growth. Towards the middle of 2021, inflationary pressures started building, which in turn led to interest rate hikes across the world. The pace and extent of these interest rate hikes created stress in the market. 2022 was an unusual and challenging year for investors, and both US equities and bonds posted negative returns. Now, a snapshot of the 3-year returns for the period April 2020 to March 2023 present a remarkable recovery of asset class prices. However, the volatility we experienced during this period was exceptionally high. Our portfolios were well positioned to benefit from the recovery and the volatility. All the actively managed institutional multi-asset class portfolios achieved double-digit returns for this 3-year period. The portfolios were ahead of their respective benchmarks and featured in the upper half of the peer group ranking tables for this 3-year period. These returns are a testament to the combined effort of our investment team, always looking to improve the process and enhance the returns we deliver to our clients. Given the increase in the allowable offshore allocation, we have in the last year increased our offshore allocation gradually and opportunistically. but we have not yet moved to our revised strategic allocations, as we are mindful of relative valuations, the level of the rand, and global macro uncertainty. We will continue to increase our offshore weightings in a prudent and responsible manner. These relaxed exchange controls, allowing portfolios up to 45% offshore, has led to a greater emphasis being placed on the global component of our clients' portfolios and how best to integrate offshore both from an investment and ESG perspective. The decision on how and where to invest, given the myriad of global opportunities, and integrating it with the South African opportunity set through a South African client lens, is a complex one. Eugene and Andrew discussed this in detail. Our approach is through global investment partnerships. We achieve this through collaboration by relying on skill sets in our South African-based investment team, our global colleagues in the UK, a strategic investment partnership with Robeco, and also through our research-driven academic partnerships. Our global investment partners give us access to world-class research. They give us access to execution strategies and portfolio construction methodologies, all aligned to our overarching outcomes-based investment philosophy and global best practice, both from an investment and ESG perspective. As always, our portfolios are well diversified across asset classes and strategies, and we are confident that our portfolios are well positioned to navigate through market volatility and to deliver on their respective longer-term objectives. On behalf of myself and the investment team, thank you again for joining us, and we look forward to hosting you again at one of our future events. Thank you for your time.